And of course, there's also ISA 501, which provides certain specific consideration to certain items in the financial statement. For example, now this is a really, really important topic and can be highly tested in the exam as well. It's basically ISA 402, reliance on service organization. Okay, folks. And yeah, now moving on to ISA 540, isn't it? So accounting estimates. So guys, what is the difference between analytical procedures and PODs, test of details? These are both of these are types of substantive procedures that we do, right? Hey everyone, welcome to another session. This is Vishnu Vijay, ACCA, a proud FinFrammer who's been teaching students across the globe and across designations. And I welcome you to this session where we will be revising through the key topics of the syllabus part D of the Audit and Assurance paper. Okay, folks? So let's not waste any time and let's get started, shall we? So as you can see on the screen over here, we're talking about audit evidence and what all key topics have we learned throughout our sessions. First of all, we looked at financial statement assertions. We looked at audit evidence itself, the standards itself, right? And then confirmations. We talked about relying on the work of others. We talked about audit procedures. We talked about computer-aided audit techniques as well as audit for not-for-profit organizations as well, right? So let's go to these key topics one by one so that you can refresh your memories again, shall we? So first of all, I'm going to get started with financial statement assertions itself, right? So remember, guys, within the financial statements, there are three categories of transactions. If you look at it, right, there are transactions and events, which are basically the items that are recorded within the statement of profit and loss. And then there's also the account balances as well, which you can find in the balance sheet, or as we call it, the statement of financial position as well, right? And thirdly, there is of course notes to financial statement, which contains all the presentations and disclosures, right? So for the transactions and events, right, we have OC as basically a mnemonic that we basically the mnemonic that we used to learn the financial statement assertions are OCER ACCP, right? I'll just quickly write it down for you. OCER ACCP, right? So guys, O and C are basically assertions that are specific to the transactions and events, basically for the items that are there at the income statement or the statement of profit and loss, right? So, and what does OC stands for? O stands for occurrence. Has the transaction or event actually occurred, right? That's basically what we are defining. And C stands for cutoff, right? Is the particular transactions or event recorded in the correct accounting period, right? So that's basically the idea. So that's what C stands for. And then for E and R, these two are assertions that are specific to the account balances, right? The items in the statement of financial position, or as we call it, the balance sheet, right? So what does E and R stands for? E stands for existence. Does the asset actually exist? If I'm recording inventory, does it actually exist? If I'm recording intangibles, does it actually exist in that particular organization, right? It's something that we're verifying. And then R stands for rights and obligation, right? So does the particular company actually own the assets, and do they really have an obligation to the liability? Okay, folks, that's what rights and obligation stands for as well. And then there are some common assertions for all items, right? Which is ACC, right? A stands for accuracy, right? Accuracy of the transactions and events as well as account balances. And then completeness. Have we completely recorded everything? And the next C stands for classification. Have we classified the particular event or transaction appropriately, or account balances appropriately, right? As an asset, as a liability, as a non-current asset, as a current liability, right? All those things. Okay, folks, that's basically the idea. And then P is specific to the notes to financial statement, which is in relation to the presentations and disclosures. Okay, folks, have we presented everything or disclosed everything in accordance with the accounting standards? Okay, folks, so that's basically as to why P stands for. So OCER, ACCP, these are the financial statement assertions. Now, moving on to the next part, ISA 500, audit evidence, right? So when it comes to the objective of the audit, as we all know, it is to provide an opinion and everything. Yes, but our opinion is always backed by certain conclusions that we reach thanks to sufficient and appropriate evidence that we have gathered, right? So what does sufficient and appropriate mean exactly? Sufficient means of the right quantity, and appropriateness means of the right quality as well. Okay, folks, so quantity is basically having enough evidence, not too much or too little, right? If it's too much, then we're unnecessarily wasting resources. And if it's too little, then we're not conducting adequate amount of work. Okay, folks, so that's basically the idea. And quality relates to the relevance and reliability of the evidence. Okay, folks, relevance means, does it have a logical connection to what we do and what we're trying to get? Okay, folks, so that's basically the idea. For example, whenever you're writing substantive procedures, right, there's always action, source, and objective, right? right? So you have to frame your substantive procedure in such a way that you're writing what needs to be done and why we do it as well, right? So is there a logical relationship as to what is done and why we're doing it is what we are verifying in relevance. Okay, folks, so that's basically the idea. Reliability is all about where you're getting the evidence from. Is it from a third party like a bank or something? That is more reliable than when it's provided by the client directly itself, right? So that's basically the idea. Okay, folks. Now, so when we conduct these, how do we get sufficient appropriate audit evidence? By conducting audit procedures, right? And when we conduct audit procedures, are we testing all the transactions that are there in the financial statements? Answer is no, right? Because I don't have the time or resources to do that, right? So what I'll do is I can take one of three approaches. I can either test 100% of the items. Okay, folks, let's say for example the debt balance, right? So if I talk about the debt balance, there might be three, four, five debts for a particular company, right? Some may have more, some may have less, right? But if the quantity of the population is low, right, then we can definitely test 100% of the items. Okay, folks, that's basically the idea. Or what we can do is we can test items with specific characteristics. Okay, folks, maybe out of a certain population, some items might be the key item, or basically it might be a high risk item, or there is a chance that there might be something wrong with a certain item, like a related party transaction or something like that, right? So for those kinds of items, we group them together. We group together certain items with similar characteristics and just test those items itself. Or what we can do is we can do the sampling approach as well. Okay, folks, we can take a sample from the entire population and then conduct the testing or conclude on the samples accordingly. Okay, folks, so that's basically the idea. So, and of course, there's also ISA 501, which provides certain specific consideration to certain items in the financial statement. For example, inventory. If I talk about inventory, inventories have an inherent risk of existence and condition. Okay, folks. So existence, as in if is the inventory that I'm recording in my books actually there, right? That's something that I have to verify because there's an inherent risk that companies may overstate inventory even when they don't have it, right? So that's basically the idea. And then secondly, there is conditions of the inventory, right? At times there might be outdated or obsolete inventory as well, which may go unidentified. Okay, folks, so that's basically the idea. And then secondly, we have completeness in litigation, right? Over litigation claims, right? So that's basically the idea. So when it comes to litigation claims, there is a chance that the client may not fully disclose all the claims that are there, right? So which is why we need to consult with the lawyers or legal advisors to get more information from them. Okay, folks, so that's what completeness means. And then thirdly, we have segment information, right? Segment information is like an advanced accounting standard. It's called IFRS 8, right? So according to the standard, if a particular business segment or a proportion of the business meets a certain criteria, it needs to be disclosed separately as an operating segment. Okay, folks, so that's basically the idea. So such instances are also provided within this particular standard. Now, moving on to ISA 505, external confirmations. So, guys, when it comes to external confirmations, we have the process of obtaining evidence from third parties, right? So, such as it's basically we obtain confirmation from for the receivable balances from the customers, payable balances from the suppliers, banks, basically the bank for the bank balance, and securities and stuff like that, which we may keep, right? Lawyers for any litigation claims, and of course, there's also third party inventory as well, because there are situations when my client will rent out some warehouse space from a third party warehouse owner, right? So we're talking about those kinds of instances, okay, folks. And we learned about receivables confirmation as well. There's positive confirmation request and then negative confirmation request. And remember how the confirmation process works, okay, folks. That's like really important for an auditor to know, okay, folks. So basically, we send the request to the particular, as in the client is the one who would be sending the particular confirmation letter to the customer, to the third party. Okay, folks, with of course, the content of that particular confirmation will be drafted by the auditor. Okay, folks, we will, of course, oversee the process. And then the particular third party will have to send back the confirmation request directly to the auditor. Okay, folks, that's a really key point. Okay, folks, it cannot go through the client back to the auditor. It has to come from the third party directly to the auditor. Okay, folks, so remember that particular point as well. So, when we talk about confirmation requests, there are two things that you have to remember: positive confirmations as well as negative confirmation requests. Okay, folks, a positive confirmation request is when you mandatorily have to respond back to that particular request. Okay, folks, the third party will have to mandatorily reply back to that particular request. That's what a positive confirmation request is. And then there's also a negative confirmation request. So we basically use a negative confirmation request when there's a low risk client, or the balance has a low risk or something like that, right? So what we do is, we will send the confirmation request, but the response is only mandatory if there's a disagreement. Okay, folks, if the customer does not agree with the account balance that is shown in the confirmation request, then they have to respond back. Okay, folks. If they agree, then it's fine. They don't have to respond back. But if they don't agree, then they'll have to respond back. That's basically the idea. Now, what are the causes of exceptions? As in, why would a particular customer not respond back, or they may say that, hey, we don't agree with the balance. Well, let's have a look. There can be dispute between the client and customer, right? There might be some court hearing or something like that, or maybe the timing difference of the transaction or something like that as well, right? So that's basically the idea. Or it could be a cutoff problem, right? As in, the client records the transaction, or the customer records the transaction could be different, right? So that could be the reason. Timing difference, basically. And then goods in transit, as in, the particular client has sent the goods, but it hasn't yet reached the customer, so they don't owe anything at the moment, right? So that's basically the idea. And then money received may have been posted to the wrong accounts as well. That's a possibility. And then cash in transit, as in the customer has paid the money, but again, it hasn't reached the client yet. That could be a reason. Net off balances of supplier and customer, as in, there's no mandatory requirement that a customer can only be the customer itself, right? They can provide goods to the client if they purchase it with money as well, right? So definitely, customers can also become suppliers as well, and their balances can get netted off. Okay, folks, that's the idea. And then fraudulent activities as well. Okay, folks, there can be some fraudulent activities, and for example, the client may state a bogus customer in their records, right? So that can also be a possibility. So these are the causes of exceptions as to why we may not get a response, or why we may get a disagreement from the customer. Okay, folks, so that's basically the idea. Just some examples to remember. Now, moving on to the next one, we have ISA 530, which is sampling. So when it comes to sampling, there are two approaches. There is a statistical approach to sampling, and then there's a non-statistical approach as well. Now, remember, guys, the sample size matters. Okay, folks. So first of all, the first thing that we do when it comes to sampling is determine the sample size, as in how much samples, should be tested. Right. That's the first thing that we decide. And this particular aspect is decided based on the risk of that particular population, risk of that particular balance, client, etc. Okay, folks, so that's basically one thing that you should consider. And after determining the sample size, then we talk about the technique using which we have to select the sample. Because, guys, the sample should be representative of the population, right? So we have to use the right approach to select the samples as well. So there is, of course, the statistical approach as well as non-statistical. Statistical is basically when you randomly select things using probability. Every item has an equal chance of getting selected. But in non-statistical approach, every item may not have an equal chance of getting selected because there's a slight degree of judgment involved. Okay, folks, so that's basically the idea. So the statistical approaches include random selection, which is just randomly selecting at using softwares nowadays. That's basically how we do it nowadays. And then there's systematic selection as well, right? Which is basically when the first particular sample is selected randomly, and the next set of samples in regular intervals are selected. That's basically the idea. And then monetary unit selection as well. We categorize the population based on its monetary value and test different items. Select different items as sample from each category. Okay, folks. So that's basically the idea. So yeah, and what else? Non-statistical approach. So what's the idea here? We have haphazard selection. So, guys, haphazard selection is when we try to randomly select the particular sample, but there might be some degree of bias or judgment involved. Okay, folks. So that's basically the idea. Block selection is when we create blocks between the particular for the particular or we categorize or divide the particular population into certain blocks and then select a sample from each block. That's basically the idea. And then judgmental selection, as we all know, we use our judgment to identify, hey, what would be the most risky item, or what would be the most representative sample, and then we choose it based on our own judgment. That's basically the idea. Okay, folks. So that's basically the idea. And what else? Deciding a sample. Designing a sample is basically when we determine the sample size itself, right? We look into the chances that a possible misstatement can happen, nature of the evidence that we're trying to obtain, like do we need a a huge amount of evidence, or is it just we just need a low level of evidence as compared to a high risk client, right? So that's basically the idea. And then combination of procedures performed and the purpose of procedures performed as well. All of these things need to be considered before determining the sample size. That's basically the idea. And then there's also a technique known as stratification, right? Stratification is basically this particular approach basically ensures that we are selecting a representative population. Okay, folks. So what we do here is we just group together items that have similar characteristics, right? And then select samples from each different categories. Okay, folks. So that's basically the idea. And yeah, now moving on to ISA 540, isn't it? So accounting estimates. So when it comes to accounting estimate, guys, the problem is that, we have some examples, right? We have the useful life of depreciation and amortization, for example, right? There's a fair value, right? There's provisions, warranty provisions, restructuring provision, all these things, right? So when we look at all of these, amounts, right? These are future possible or probable obligations that can happen, right? Right. So, or futuristic values that are there, or market, amounts that are based on market values, etc. So, there's a greater degree of judgment involved, right? So, how does the auditor audit these things, right? Of course, they obtain a written representation and stuff like that. Most definitely, yes, that's the by default procedure. But there are also other things that we can do, known as creating the auditor's point of estimate, for example. Okay, folks. So, the management will have the management's point of estimate, which is the methodology that they've used to calculate it, or the judgments or assumptions that they've used to calculate it. And the auditor may use their own, opinions and judgment to make the calculation. Ideally, of course, these two numbers may not agree with each other, but there should only be a slight difference between them. If there's too much of a difference, then that means something is wrong. Okay, folks, so that's basically the idea. So yeah, that's basically how we audit accounting estimates. And then we talk about analytical procedures as well. So guys, what is the difference between analytical procedures and PODs, test of details? Both of these are types of substantive procedures that we do, right? So when it comes to substantive procedures, there are two types. Analytical procedures, when we compare financial and non-financial data to identify plausible relationships, right? So that's basically what analytical procedures are. And then there's test of detail is basically when we do the testing at transaction level. Okay, folks, so that's basically the idea. So, when it comes to analytical procedures, there are some limitations though. Okay, folks, because in analytical procedures, we're only looking into the total figures, right? The total figures in the financial statements. We're not digging into any transactions. We're not looking into journal entries, ledgers, or anything. Just the financial statement and the total balance, which is there. That's just it. Okay, folks. And then we compare that particular current year balance with the previous year, or we may conduct ratio analysis, we may conduct trend analysis, right? But it's all on the total figures, right? But whereas test of detail is when you test the transaction at the transaction level itself. We break down the total figure and we dig a little deeper. Okay, folks. So that's basically the difference between these two. So when it comes to limitations, the misstatements can cancel out each other, and this may be undetected. And then there should be used if internal controls are reliable as well. Okay, folks, we can only use analytical procedures, or we can only we can take an approach where we can only do analytical procedures if the internal controls are reliable. Else, there's a huge amount of risk, isn't it? So that's basically the case. And of course, the first point means that, let's say that there's an overstatement in one of the transaction of $100,000, and then there's an understatement in another transaction of $100,000 as well. So this overstatement and understatement can net off each other in the total figure, giving a zero impact, right? So this zero, if you look at the face of the figure, if you only look at the total figure, then will I be able to identify any misstatements? Answer is no, right? Why? Because the misstatements are netting off with each other. Okay, folks. So that's basically why. That's basically the limitation that is mentioned over here, which is why we do TODs as well. Okay, folks. Now, moving on. Now, this is a really, really important topic and can be highly tested in the exam as well. It's basically ISA 402, reliance on service organization. Okay, folks. Relying on the work of others have three standards, right? One in relation to service organization, the other in relation to internal auditors, and then experts, right? All of these are important. You always have to remember what are the things that we should look before placing reliance, and how exactly do we get information to do that. Okay, folks, these two things need to be looked into. So let's have a look at this one, shall we? Before placing reliance on service organization, who are service organizations, by the way? It's basically the organization to which the client outsources certain functions to, isn't it? That's basically the idea. So before placing reliance, we have to have a look at the nature of the services and their effect on internal controls, right? And then nature and materiality of transactions to the entity, like is there any significant transaction or not, right? That needs to be looked into. The level of interaction between the service organization as well as the clients needs to be assessed. And then the nature of relationship as well. What are the terms and conditions between the service organization as well as the client? Okay, folks, these things need to be looked into. And where do I get these information from? I'll get this information from a type 1 or type 2 report, right? That's basically one way of getting the ATM. Remember, guys, in type 1, what all things do we have? We have the design, and do we have the operating effectiveness of the internal controls? No, right? That's basically the ATM. Okay, folks. In type 2 report, we have the operating effectiveness, as in the service auditors will see that ensure as to whether the internal controls operate effectively in type 2 reports. But in type 1 report, we just have the design overall. Okay, folks, that's basically it. There's no comment about the operating effectiveness as such. Okay, folks, just the design and the description of the control. That's just it. That's what's in the type 1 report. In the type 2 report, we also have the operating effectiveness aspect as well. And then secondly, we can contact the service organization through the client if it's deemed necessary. We can visit the service organization if needed, right? If we identify too much issues or something like that. And then we can use another auditor to perform necessary procedure, like the service auditor. Okay, folks, so that's basically the idea. So yeah, this is how we get the information to place reliance on the service organization. Now, moving on to the next part, we have reliance on internal auditors as well, right? So how do I rely on internal auditors? Of course, there are two approaches that we can take, right? So we can either use a direct assistance approach when it comes to internal audit, right? So what is direct assistance approach? Basically, when we use them, when we use internal auditors to conduct the audit work, to conduct the external audit work, or we use them as our staff itself or our audit resource itself to do some procedures in some low risk areas or areas that require less judgment and areas that have a less amount of complexity. Okay, folks, so that's basically the idea. So that's what why we use or how we use internal auditors for direct assistance. So remember that particular point. And of course, when it comes to internal auditors, what all things can I look at before placing reliance? I can, of course, have a look at their independence and objectivity, right? Right? And then, we can have a look at the qualifications and technical competence of these individuals. Are they qualified individuals? Do they have the sufficient amount of technical knowledge and experience, right? All these things. Their professionalism to a certain extent. And then, is there any constraints imposed by management that limits their authority? Okay, folks, all these things needs to be looked into. And where do I get these information from? From the work papers that they have done, right? They would have their own internal audit work papers, so we can review them to ensure that they're documented properly with proper sign-offs and everything. And then, are the evidence that they've gathered sufficient and appropriate? And is there any conclusions drawn? The conclusions drawn by them are reasonable and valid. And of course, the management have acted on these recommendations as well, right? So all of these things needs to be looked into, before placing reliance on internal auditors. Okay, folks, remember that. Now, finally, we also have experts as well, right? So before placing reliance on experts, what all things do I have to do here? Basically, I have to check the competence, capability, and objectivity, right? And how do I do that? Like, I ensure that they're a member of a recognized professional body, and the experience that they have, the qualifications, and if there's any ethical threat, like do they have an interest in the client or something like that? Okay, folks, so that's basically the idea. And before doing the work, what we do is, if it's an auditor's experts, let's say, right? We agree the nature, scope, and objective of the expert's work, the roles and responsibilities that they have, nature, timing, and extent of communication, as well as we make them sign some confidentiality agreements as well. Okay, folks. And then after the work, we ensure the consistency of their work with the other findings that we had from that we obtained as audit evidence, right? And then the relevance and reasonableness of the assumptions that they've used, as well as the completeness and accuracy of the source data from which they have done calculations and stuff like that. Okay, folks. So all these things are verified after the work is done by the auditor's expert as well. Okay, folks, because ultimately the liability comes on the auditors itself, right? Within our auditor's report, we do not mention the auditor's experts at all because we do not share the liability of the audit report with anyone. Okay, folks, that's basically why. Now, moving on to the next part, we have computer-aided audit techniques, right? And as part of which we learned about test data, right? So what is test data? It's basically when you input some dummy data into the computer system of the organization, right? To see if it is being processed properly, right? So that's basically the idea. We have live and dead test data. Live test data is basically when you conduct the test data procedures during the normal operational cycle. Okay, folks, which is during work hours, basically. Okay, folks. And test data is just the exact opposite, right? So it's basically when you do it outside the working hours, right? So that's basically the idea. And then audit software, right? So when it comes to audit software, what's the idea here? There are tailor-made softwares as well as ready-made, or I would say off-the-shelf, softwares as well, right? And what do we use it for exactly? We use it for quicker calculations. We provide, of course, we have to provide training to the auditors on how to use these softwares as well, which can incur some additional training costs, but the benefit here always exceeds the cost. And then we can test more transaction with the use of these audit softwares as well as another disadvantage I would say is that we cannot identify if there's any algorithmic errors or coding errors or something like that within the particular software, right? So because we're auditors and our knowledge is primarily limited to accounting and audit itself, right? So that's basically the idea. But we do conduct these IT audits and stuff like that where we ensure we just have to focus on the output, right? So as in, is the system giving the output that it's intended to do? Okay, folks, we don't have to review through all the codes or anything like that, right? But we just look into the output and verify as to whether it is the right one. That's basically the idea. Okay, folks, so that's basically some benefits of audit software. And then we also looked at data, big data and data analytics as well. What was big data? Basically a huge amount of data that is processed through supercomputers, right? And it has four V's, right? So what all are the four V's? Volume, velocity, um, and then there's variety and veracity as well, right? So there are more V's that are in discussion, but primarily there are four, right? Volume is the large volume of data that we have. Velocity is the speed at which we can get the data. Variety is the diverse data that we have, and then veracity is the accuracy of the data. Because it's not about having a huge amount of data; it has to be accurate data, right? Otherwise, it's of no use to us, right? So that's basically the idea. And what is data analytics? Data analytics is basically when you process these data to identify pattern, trends, and correlation that can be used for different business purposes. Okay, folks, so that's basically the idea. There are many benefits and costs in relation to it. For example, cost involve training costs, right? So whenever there's a need for implementing something new, right? So there's always a training cost that are there. Okay, folks, to help the employees familiarize. So in our case, to help the auditors familiarize with these, new technological advancements, right? So that's there. And what else? And finally, we have auditing of not-for-profit organizations as well. So what's the story here? We're talking about, what is the objective of not-for-profit organization? Is it financial in nature? Definitely not, right? It's not. It's not all about maximizing shareholder wealth, right? Their primary objective is philanthropic, right? As in, it's good for the society and stuff like that. And there are no shareholders, there are no dividends, right? So we don't measure things in a, I would say, financial manner, right? Instead, to assess performance of these kinds of organizations, we implement the three V's, right? What are the three E's? Value for money, right? The first E starts with economy, and then there's efficiency, and then effectiveness, right? Now, but that's not the important part here, right? So when it comes to not-for-profit organization, there's an increased amount of audit risk. Why is that? Because there's a high level of control risk as trustees devote inefficient time, as in, see, most employees of these not-for-profits are usually, work on a part-time basis or they just volunteer, right? So they may not have the knowledge that, there should be internal controls here to ensure this, and this things, etc., right? So those kinds of issues can be there. And then, there's no segregation of duties since they are volunteers, they may not be permanent, first of all. And there might be a small number of people to handle a lot of jobs as well, right? So that's basically the idea. So due to which control risk can increase. And there are other risks like, dependency on donations, government grants, etc., right? For example, see, government grants have conditions attached upon them, right? And there's a high risk that these conditions may not be met by these not-for-profit organizations because their primary source of income is donations. And are donations regular? No, not really, right? So that's basically the idea. And then there can be going concern issues for these organizations as well. So that kind of increases the audit risk as well. And then compliance issues, like, for example, organizations like charities, for example, need to comply with a lot of tax regulations, right? So, if those kinds of regulations are not complied with, then that can increase nuclear risk related risks, right? So that's basically the idea. And then, you need specialized audit knowledge to audit these kinds of entities as well. Okay, folks. So that's basically it. So that's basically as to what we've covered in this particular syllabus area. I just ran through the key topics. Of course, there are more and more in-depth things that are there, which I hope you guys have gone through. But it's just to refresh your memory, just before the exam. And yeah, that's basically it. That's basically all I wanted to cover in this particular session. I hope you enjoyed it. And I'll see you later in another video where we will discuss, some more topics. Okay, folks. So till then, this is Vishnu Vijay signing off.